We would expect that the price of the S&P will be higher 10 years from now than it is today.
Okay. And now we need annualized returns. Are you going to tell me mid-single-digit returns, including dividends, for the next 10 years in the U.S.? Is that?
I think
or do you have to do more?
Yeah, and I would go to low single-digit returns for the U.S. equity market, and it's actually surprisingly easy to forecast 10-year real returns for equity markets, as Professor Schiller taught us that the price you pay for a series of cash flows has a very profound impact on the return that you will receive over coming periods. Trying to forecast the daily or weekly or quarterly ups and downs of prices, much more difficult, but trying to understand the long-term return is a function of the price you pay, and the price you pay for the U.S. stock market is very high relative to cyclically adjusted earnings.
Okay, so, but will that be the highest return asset class, even though it's low single digits?
No,
then
not
what
at
will
all.
Be?
I would expect emerging market equities will be
equities,
the highest.
Just not domestic equity, emerging market equity.
Yeah, they're
because of where they are right now, or because
less than half the price of the U.S. equity market in terms of cyclically adjusted earnings. Yeah.
Okay, so we should do this immediately and eschew domestic equities and go where?
Most investors, I find, have a under-diversified portfolio. They tend to concentrate into mainstream stocks and bonds. And now is a particularly opportune time to diversify away from...
Some kind of fund in all emerging markets? Frontier markets, emerging markets, Europe,
sure.
South America, where?
I think a broadly diversified emerging market portfolio is the right answer for most investors. If we are to scrutinize individual country markets to find the best bargains, you'll find them in places like Turkey, Russia, Brazil. Again, I wouldn't suggest that people put a lot of their money in an individual emerging market country, but I kind of like Brazil. The changes there, I think, are quite positive for the Brazilian equity market. Well, yeah, you know...
they elected the Brazilian Trump. Is that good?
Well, what happened to the U.S. equity market right after Trump got elected?
I don't like to talk about that. You know, it goes against morally everything that I think about. Anyway,
Chris, how do you explain the volatility, though, in a lot of these asset classes to the investor, in particular the emerging markets?
Well, they are very volatile, and they're very risky. You can find any number of very good reasons to expect a high risk premium. But that's just exactly how you earn higher long-term returns, is high risk premiums, meaning discount prices, meaning higher returns. U.S. equity market, exactly the opposite. The least risky market, the most expensive, therefore likely the lowest return over the long run. The other thing that I think is really important about the U.S. equity market is peak earnings. We have had a quarter century of faster growth in earnings per share than the economy, and that's not normal historically, and I think it's coming to an end. And I think usually you want to disregard politics, but today politics is quite important, particularly the focus on new antitrust regulation.
I mean, I would like to think that we have, in terms of rule of law here, innovation, the ability to get capital for startups,
we have
an educated workforce. So all these great things, I would imagine. I would always like to invest here, but I can see what you're saying, because it's the term. It's already in the market. It's already in the market that we have probably our economy is probably stronger. We may have, a better platform to succeed, but we succeeded for years already, so it's not quite as cheap as other places. Is it as simple as that?
I think it is, and I think it's more than in the market.
Okay, even more than in the market.
10 years, Joe.